let's look at how we can deal with risks in cost-benefit analysis. The first approach is to compute. The first approach is if we are risk neutral, we just ignore risks, we just compute the expected values. So estimate all benefits and costs using expected values and assuming risk neutralities. And that create expected NPV. So we have seen this previously. The second approach is accounting for risks in terms of sensitivity analysis. Okay, with this approach, the researchers provide the results in such a way that the reader or clients can automatically obtain results using assumptions which can be different from those of the expected or core situations which the researchers has used. And good thing about this is that this allows the decision makers to examine the project using their own expectation. Okay, let's look at the examples. Suppose we have this project. So we set up projects that has initial cost of $500 and it's going to last for 10 years. Discount rate is 10%. And in terms of output, there's a unit cost of $2. If in the pessimistic situations, then the quantity output will be 80 units, which with a price of $8 per unit. In the optimistic situations, the output will be 120 with a price of $12. In the expected situations, output is $100 with price of $10. Okay, suppose we have calculate we can calculate, given this information, we can calculate the NPV associated with the pessimistic situation, expected situation, and optimistic situation. And we present these calculations to the clients, and clients can make decisions based on these different scenarios. Okay, let's calculate these NPVs. Okay, so this let's use timeline here. $10 years. So there's initial cost of $500, and let's look at expected situation. So the output is 100, price is $10, and for each unit there's $2 cost. So this occurs from year 1 to year 2, year 3 until year 10. So the cash flow pattern is simple. This is just present value of a 10 years annuity with per year payment cash flow of 100 times 8. Okay, so we can use this formula, present value of annuity, so which is per year payment times an annuity factor. So the annuity factor, the annuity factor we can calculate as this 10. So I is we are told is 10%, 0.1, and this is equal to 6.144567 is this. Alright, so For the expected situation, per year cash flow is this many times annuity factor minus the cost, which is already present values. So we end up in having $4,416. Similarly, calculate for the pessimistic situation, for the optimistic situations, and then present this NPVs, this NPV of different scenarios to the clients. Clients can make decisions based on their own judgment there. And this is called sensitivity analysis. So in practice, this is the most useful approach because it is theoretically valid. It's based on our assumption is theoretically valid. And it can be easily understood by the clients, right? And also leaves the clients somewhat in control of the assumption. Leave some rooms for the clients to make the decision based on their own assumptions.